Yeah, I'm just continuing. Just wait a bit. Okay, so let's just start off. This is a question. The name of this question is Stent Company. The name of this question is Stent Company, and the requirement to this question is discuss the appropriate accounting treatments which a stent company should adopt for all issues identified above and their impact upon gearing. So what do you need to do? You need to talk about the stent company, every single accounting treatment, and what is going to be the impact upon the gearing. That is something that you have to talk about. The second thing is it says discuss the ethical issues arising from the scenario, including any actions which the accountant should take to resolve the issues. So this is something that you have to talk about. Now let's just start discussing this question, that what are the things which are covered up in this question. Now let's just see. It says Stunt Company is a consumer electronics company which has faced a challenging year due to increased competition. A Stunt Company has a year end of 30th September 2009, and the unaudited draft financial statements report an operating loss. In addition to this, the debt covenants limits based on the gearing are close to being breached, and the company is approaching its overdraft limit. And the company is approaching its overdraft limit. So if I talk about this assistant company, try to understand this. It says it's a consumer electronics company which has faced a challenging year due to increased competition. Stunt company at the year end of 30th September 2009, and the unaudited draft financials report an operating loss. So your unaudited draft financial statements, they report a loss. Now, what next is there? The next situation is, it says the cash advance from Budster company. So what is it? The cash advance from Budster company. Let's try to understand what happens with the cash advance from the Budster company. It says that on 27th September 2009, Stunt company's finance director asked the accountant to record a cash advance of 3 million received from a customer. So the 3 million has been the advance which is received from the customer. Just see this, you're getting a close to being breached. But the company as a reduction in trade receivable. So it says as a reduction in trade receivables. So what was the accountant required to do? So the finance director required the accountant to actually record what? Actually record this $3 million as a reduction in receivable. Now, but the company is solely owned by Stunt company's finance director. Okay, so now here what happens is the finance director owns Budster company. So this Budster company is actually going to be a related party. This Budster company is actually going to be a related party. The accountant has seen an agreement signed by both companies stating that 3 million will be repaid to Budster company in 4 months time. So that means it's actually a loan agreement. The finance director argues that the proposed accounting treatment is acceptable because payment has been made in advance in case Budster company wishes to order goods in the next 4 months. However, the accountant has seen no evidence or any intent from Budster to place the orders with the Stunt company. So now let's try to understand what are they trying to do. Um, Here the important points that need to be mentioned are these. I repeat, there are few important points that you need to mention. And what are those important points with respect to this? Let's try to understand first. Number one of them is that the Budster company is owned by finance director who is a key management personnel. Therefore, Budster company is a related party, and the related party disclosures in accordance with IAS 24 are required to be made. So what happens is Budster company is owned by finance director who is the key management personnel. Therefore, what happens is the Budster company is a related party, and the related party disclosures in accordance with IAS 24 are required to be made. The disclosures would be about the amount of transaction, the amount of bad debt written off during the period, the provision for bad debts, the terms and conditions under which this has been done. Now, additionally, the substance of the transaction is required to be understood. The substance of the transaction is required to be understood. Since the amount is received with a commitment to repay, therefore, it is a financial liability. The reduction in receivable is not an acceptable treatment. So you need to tell them that the reduction in receivable is not an acceptable treatment. Instead, a financial liability is required to be recognized as the entity has an obligation to repay. So what happens is there are few important points which you need to mention with respect to this scenario. And what are those things that you need to mention with respect to scenario? One of them is that it is, I repeat, what is it? One of them is that you have to make sure that you actually, so amongst the various things that you need to consider, one of them is that um, this is a related party transaction. So the appropriate disclosures of the related party are to be made. Number one, this is the related party transaction. So the appropriate disclosures of the related party are required to be made. And the second thing is that it's not a sale transaction. I repeat, it's not a it's not a transaction where you have received the money. It's not a receivable. It should not be recognized as a reduction in receivable. Rather, what should be done is it should be recognized as a liability separately. It should rather be recognized as a liability separately. So this is how you would actually be required to measure it. I repeat, this is how you would be required to measure it. Hopefully everyone is okay with it. Okay, now let's move a bit forward and let's discuss further. Okay, the legal form of this transaction is that it's an amount received from the legal form of the transaction is that it's an amount which is received from the customer. But the in substance transaction is that it's not an amount received from the customer. I repeat, the in substance transaction is that it's not the amount received from the customer, but it's rather a liability. Okay, now see, yeah, furthermore, what happens is there is another point which you people can mention and which you should mention. That is that if you have to, I mean, like this is a good point that every one of you should also mention, which is that um, if the entity is recognizing the amount, if the entity is recognizing the amount received, I repeat, if the entity is recognizing the amount received as reduction in receivable, this offset and it intends to offset. So this is something that you would have to keep in mind. I repeat, this is something that you would have to keep in mind. This is how you're going to answer this part of the question. Yes, this is arising from the same entity. So you have to be like this. You have to add like this. Is that okay now? Okay. Let's move a bit forward. Let's discuss further. Now, the next part of this question is about the preference shares. It says on 1st October 2008, the CEO and the finance director each paid 2 million cash in exchange for preference shares from Stent. So the CEO and the finance director each paid $2 million cash in exchange for the preference shares from the Stent. Now what happens is that which provides cumulative dividends of 7% per annum. These preference shares can either be converted into a fixed number of ordinary shares in 2 years' time, or they could be redeemed at par on the same date, at the choice of the holder. The finance director suggests to the accountant that preference shares should be classified as equity because the conversion into fixed number of ordinary shares on a fixed date and a conversion is certain given the current market value of the ordinary shares. Now try to understand something, which is that um, when it comes to the classification of the instruments into the equity and into the liability, the classification of instruments into equity and liability needs a careful assessment. And a financial instrument, the major distinguishing feature of financial liability and equity is that under the equity, there is an absence of obligation to pay cash. So what happens is under the equity, there is an absence of obligation to pay cash. So when you have this absence of obligation to pay cash, I repeat, whenever there is this absence of obligation to pay cash, so that makes an instrument to be an equity instrument. The fact that the preference shares can be converted into fixed number of shares makes it a monetary item rather than non-monetary. I'll explain to people how. Furthermore, the option on the part of the holder to redeem preference shares creates yes, Shabna, you will get the links to both YouTube and the Facebook. Okay. So furthermore, the option on the part of the holder to redeem the shares creates an obligation to repay. Now, so these are few things that I've told you people. Now try to understand. What happens now is that assume that you have issued preference shares of 100,000. This can either be redeemed for cash. So the redemption for cash makes it a liability. The redemption for cash makes it a liability. Okay, so it becomes a liability. Now, the second thing is it is convertible into number of shares. Now, the question mark that arises is that what is the number of shares are they convertible into? I repeat, what is the number of shares they are convertible into? So for example, if it is convertible into the fixed number of shares, that means assume that I tell you that this $100,000 preference shares could be converted into 10,000 ordinary shares. So what happens is 100,000 divided by 10,000. 100,000 divided by 10,000 means what? Means that the price of each share considered for the purposes of conversion is $10. Now, even if the price of the shares become $12, or the price of the shares become $14, you will get 10,000 shares. And when it has got variable number of shares, so what happens is the payment is usually like this: 100,000 divided by market value of the share. So that is the number of shares you can convert into. So for example, if the market value is $10, or the market value could be $12, the market value could be $15, the market value could be like anything. So what happens is, what can you do? You can say 100,000 divided by 10. That means it's being converted into 10,000 shares. 100,000 divided by 12. That means it's being converted into 8,333 shares. 100,000 divided by 15 means that it is convertible into 66,667 shares. Now see, if an instrument is convertible into variable number of shares, so we call this specific situation to be We call this a specific situation to be a situation where it's a monetary item, where it is considered to be a financial liability. But if it is convertible into fixed number of shares, we call it an equity instrument. I may have put in a wrong definition up here. Wait. Okay, in fact, makes it non-monetary rather than monetary. I made a bit of an error over here. So this is something that you have to understand. Try to understand this. If you come across such a situation where what happens is, if it is convertible into fixed number of shares, if you convert into fixed number of shares, it's an equity instrument. If you convert it into variable number of shares, that's a that's going to be considered as a liability, a financial liability. So here, if you look at this specific situation, you can either redeem it for cash, that makes it a liability, or you can convert it into the fixed number of shares. Is that how it is, right? And to fixed number of ordinary shares on a fixed date. So what happens is, how would you write down the answer? You would say the option to convert is an equity option and option to redeem is a liability. Therefore, entity has issued a compound financial instrument and it should recognize, the entity has issued a compound financial instrument and it should recognize both equity and financial liability. And it should recognize both equity and financial liability. Do you people get it now? I thought if you are supposed to pay a fixed number of shares, that's an obligation, so a liability. No, that's not an obligation. You see, what happens is, this is what I explained to people. If you are paying variable number of shares, because you see, ultimately, if you are giving variable number of shares, that means you are repaying 100,000. If you are giving fixed number of shares, you are not repaying 100,000. It could be even more than 100,000 that you are repaying in the form of shares. Yeah, it's a convertible preference shares, right? Now, what next is there? The next situation is, I repeat, the next situation is, yes, this scenario would lead to equity. That's what I told you. Now, see, what are you going to do? You're going to say that the instrument is to be splitted between equity and liability. The equity portion would be the residual value, would be the residual after deducting liability from the fair value of instrument. The fair value of liability to be established as present value of future cash flows. As present value of future cash flows. Now, what else do you need to do? You need to understand this thing, that the fair value of liability to be established as present value of future cash flows. So, an adjustment to the amount of equity recognized is required to be made. So what happens is, an adjustment to the amount of the equity that has been recognized is required to be made. So this is how you're going to answer this question. I'm just going to zoom out the whole answer so that you could see that there are multiple parts to it. In short, what I could just tell you is that since you as an entity, I repeat, what in short I can tell you is that since you as an entity have an obligation to repay, or the other way around, you as an entity can convert them, I mean, like the holder can convert them into the ordinary shares also. So if the holders can convert them into the ordinary shares, that would make them an equity, and the fact that the holder can opt for redemption, that would make it a liability. So since this instrument includes both the equity and the liability element, therefore it's a compound instrument, and what you should be doing is you should be recognizing both the equity and you should be recognizing both the liability, both. So we are done with this questions, this part also. Now, lastly, deferred tax asset. It says Stent Company includes a deferred tax asset in its statement of financial position based on losses incurred in the current and the previous 2 years. So what does it include? It includes a deferred tax asset based on the losses which are incurred in the current and the previous 2 years. It says the finance director has asked the accountant to include the deferred tax asset in full. He has suggested that on this basis the Stent will return to profitability once in funding issues are resolved. Now see, here what happens is you have to understand what IAS 12 says with respect to the deferred tax asset on unused tax losses shall be recognized to the extent that the entity is able to demonstrate to the extent which the future profits will be available against which such such losses can be offsetted. In order to offset the entity must be able to demonstrate, must be able to demonstrate a reasonable forecast of the profits likely to arise. So you cannot recognize a deferred tax asset. You cannot recognize a deferred tax asset on the unused tax losses till the time the entity is able to demonstrate that the future profits will be available against which such losses could be offset. Are you okay now? Yes, it is highly likely that they would not have the profits in future because they have been incurring losses and they might not have sufficient profits in the future against which such losses could be offset. Okay, now see, what next is there? Yes, you can add it to the answer. I had kept it for the last point where the ethics would be discussed. It says the accountant has been seen in her position for only a few months, and finance director has recently commented that all these accounting treatment must be made exactly as I have suggested to ensure the growth of business and the security of all our jobs. Both finance director and accountant are ACCA qualified accountants. Now, what do you need to do with respect to this ethical dilemmas, the ethical issues? So I told you earlier in the day also that you have to identify that which one of the ethical principles is being compromised. You have to identify which one of the ethical threats actually arise. So the integrity is being compromised over here. The professional competence and due care is also being compromised. The self-interest, where there is actually a personal interest, this threat exists, and also the intimidation threat exists. So what you could do is that you could mention over here, the entity has been incurring losses. The covenants are about to be breached. Finance director has is forcing accountant to engage into fraudulent financial reporting. The offsetting of financial liability with financial assets, recognition of equity in respect of preference shares, and the lastly, the deferred tax asset on unused tax losses have all been misstatements in financial statements largely undertaken to avoid the breach of covenant. The integrity of finance director is lacking and he is not exercising the due care in the estimates used. The accountant is faced with a challenge where his integrity would also be compromised and where he is also facing an intimidation threat because of the senior member of the team forcing him to undertake such transactions. The accountant should consider discussing the matters with audit committee. Also consider reporting the matter of finance directors ethical of finance directors non-ethical behavior to ACCA after seeking legal advice. Okay, sir, how can while saving debt covenant of director manipulate currency? Okay, it's a self-interest. Why? Because uh, he believes that in case if the debt covenant is breached, his job is going to be at loss. Yes, Imran, you have to use the future profits estimates. Tawfiq, okay, my mistake. I didn't notice that she's a lady. I just thought that the accountant, I just worked with respect to the accountant. So anyways, I think you people are okay with it, right? So we are done with this question also. The name of the question was a stunt company. The name of the question was a stunt company. Okay, let's move on to the next question. Okay, you can see the last screen. Yeah, you can mention about the resignation also. Yes, the resigning is available option, but also right now there is another issue that has arisen, and that is that it's not just going to be the resignation that's going to work. You are faced with an issue where somebody who is calling himself to be the professional accountant is actually breaching is breaching the code of ethics also. So as a professional accountant, you may also be required to report this thing also. Okay, now see. Yeah, Vajat, you can mention this here, but don't mention it in the examination, or else you will be lost. Now see, so we are done with this question. Let's move on to the next question. We have many more questions to be done, and I need to gear up for the AFM extended class of tomorrow also. So let's get over as soon as possible. इजाज भाई लानी पड़ती है, क्या करें. Okay, now Akshay, you are asking a question that what is the marking scheme. So you see there, let me explain you one thing, which is basically um, that it depends. A lot of people think that 1 mark 1 point. I repeat, a lot of people think 1 mark 1 point, but it's not always the case. It depends upon how complicated the situation is. It depends upon how complicated the scenario is. Accordingly, you decide the marks. So what I would suggest is that you try to identify whatever that you can and then just write it down. If you are able to identify many more points, then you can restrict the points. But generally what happens is we are not faced with a situation where we find more points than the marks available. So try to find whatever you can. Now, this question, it says Digivire company has developed a new business model whereby it sells music licenses. So Digivire company, what it has done is it has developed a business model where it sells music licenses to other companies, which then deliver digital music to consumers. So there are multiple requirements to the question. One of them is advise the directors of Digivire company on the recognition and measurement of the CLA Music Company shares received as a revenue for the sale of 3-year licenses, and how they should be accounted for in financials for year ended so and so, so and so, and the royalties which CLA Music has agreed to pay as the revenue for the sale of 3-year licenses. Your answer should demonstrate how it is supported by the revised conceptual framework. Now, a lot of you people would be like, how would we deal with it in the exam? How would we deal with the conceptual framework in the exam? We have not studied it. Don't worry. Ignore it. Ignore it. You always have the option to ignore. Why do you need to worry? Why do you need to panic? You always have the option to ignore. So just ignore it and move forward. If you don't know how to do under the framework, just ignore it and move forward. That's the best thing to do. And write down the treatment as per the accounting standard. That's it. Don't worry about the when the examiner uses the word framework. So now let's just see. We'll try to see how the answer could be done for this, because I think this is one of the part, right? And the royalties agreed to pay. So these are the two things that we are gonna go about. Now it says DigiWire has agreed to sell Kla Music Company, an unlisted technology startup company, a 3-year license to sell DigiWire catalog of classical music to public. So what have they decided to sell? They've decided to sell an unlisted technology startup company and a 3-year license to sell DigiWire's classical music to the public. This catalog contains a large selection of classical music which DigiWire will regularly update over a 3-year period. It says as a revenue for the 3-year license, Kla Music Company has issued shares to DigiWire Company equivalent to a 7% shareholding. Voting rights are attached to these shares. DigiWire receives the shares in Kla Music on 1st January 6, which is the first day of the license term. DigiWire will also receive a royalty of 5% of the future sales revenue as a revenue for the license. So we need to see that how is it going to be accounted for. So take 2-3 minutes and then I'm going to start off. You need to read through this part of the question also. Okay, now see. Um, this is a 3-year license. Then it says on 1st January 6, Kla Music Company was valued between 4 million to 5 million, a professional valuer who used a market approach. The valuation was based on the share price of a controlling interest in a comparable listed company. For the financial year end of 31st December 6, sales of the classical musics were $1 million. At 31st December 6, a further share valuation report had been produced by same professional valuer, which indicated that Kla Music Company was valued in the range of 6 to 7 million. Now see, a very important point that you need to understand, there are multiple aspects of this question. And what are those multiple aspects of this question? One of them is the revenue recognition. We need to see, somebody is saying that it's a share-based payment transaction also. I'm going to explain to you whether it's a share-based payment transaction or not. Now try to understand this. When we talk about this DigiWire company, just try to understand what is happening. You are DigiWire company. This is a company whose name is Kla Music Company. You have entered into a contract where over a period of 3 years, you have given them your classical music collection. And what have they given you? They have given you shares in their own company. What have they given you? They've given you the shares in their own company. So this is what has happened. Now what is going to happen now? So one of the question is it a share-based payment transaction? My question to you people, is it a share-based payment transaction? My question, yes. Can you just let me know? Is it a share-based payment transaction? No. Why no? Why no? I need an answer. Why no? Okay, please write down your answers with all panelists and attendees. Just mention the answer with all panelists and attendees so everyone could see. Why no? Why is it not a share-based payment transaction? It's not given to employee. Okay, what else? Who else? Okay, Ananya, very good. Very good. Now see, the main point here is that we are talking about the accounting in the books of DigiWire. We are not accounting for Claw Music Company. For Claw Music Company, it's IFRS 2. For DigiWire, it's IFRS 15. For DigiWire, it's IFRS 15. See, try to understand the difference. For whom are you accounting? You're not accounting for Claw Music. You're accounting for DigiWire. So a lot of you people have given different reasons that it's not given to employees and etc. etc. No, that is not the case. The case over here is you're not accounting for Claw Music. You're accounting for DigiWire. For DigiWire, it's a revenue recognition transaction. It's not a share-based payment transaction. I repeat, 7% shares are of a startup company. This startup company is unlisted. The share valuation is a question mark. So what happens is, it's a level 3 measurement under IFRS 13, where what would happen is you've got multiple approaches available, which is the market approach, the cash flow approach, and the third one of them is net assets approach. So the market approach is that what you do is that you identify similar type of transaction in market. The market approach is you identify similar type of transaction in market. Now, the second thing is the cash flow approach is that you establish the value using present value of future cash flows. And the net assets approach is that you use the market value of net assets of the entity and you value the entity on that basis. Here, if you go about it, I repeat, if you go about this specific transaction, the okay, Okonula, yes, my mistake. It's level 2, not level 3. Sorry. It's level 2 because there are available inputs in the market. Now, see, what happens next is that the next thing is that here a similar type of transaction has taken place. And the value under the similar type of transaction has been what? Has been valued at 4.54 million to 5 million by professional valuer who use market-based approach. This valuation was based on share price of a controlling interest in a comparable listed company. 4 million to 5 million. So if you multiply 7% here, this multiplies 7% here. How much do we get? This is 280,000. This is 350,000. So what happens is the range is in between this, but it needs to be discounted. Why? Because it is not listed. Why? Because you are buying non-controlling a stake. So no premium. So hence what happens is that maybe some discount to this value. Yes, you can take average. You can take a midpoint. Let's say, how much is it? 315,000. So what happens is you could recognize this investment debit by 315,000. And the revenue is going to be credited by 315,000. You can go for the lower of 4 million also. But this revenue is to be recognized over a period of 3 years. This revenue is to be recognized over a period of 3 years because it is a revenue for 3 years of service. Because it's a revenue for 3 years of service. So in short, if I could summarize, this is the double entry that is going to happen. You are going to be recognizing investment because you have received the shares, and you would be recognizing the revenue at 315,000. Although the value, at year end is also given. I repeat, the value at year end is also given. The value at year end is also given, which is what? Which is this 6 to 7 million. But this value is not going to be considered. Why? The reason being, it's a year end value, and the revenue is recognized on the date the contract is being entered into. So the transaction price is established on the date when you actually receive the consideration. Let me repeat again. See, what happens is, first of all, you need to understand you have entered into a sale transaction, and as a result of that, the consideration that you have received is a non-cash item, and the non-cash item is a shares. So you have received shares. So you would recognize investment of 315,000. You would recognize investment of 315,000. And with respect to the revenues of 315,000 are going to be recognized on this basis. And what would happen is, you need to make sure that this revenue is to be spread over the period of 3 years. Now, the discussion that we did over here, this is all relevant discussion because you need to explain to the examiner that, look, the value of this company, the shares you have received as a consideration, those shares need to be recognized as a revenue. Yeah, it's a deferred revenue right now, and it will be transferred to the P&L slowly and gradually. So if I could just write down the pointers for this answer, I can actually say that DigiWire has entered into a sale transaction. The consideration is non-cash, that is shares of Claw Music. An investment equal to fair value of shares on the date of contract is to be recognized. Revenue equal to fair value of shares received is to be recognized. Since contract is for 3 years, therefore revenue is to be recognized over 3 years. The market value available can be used as an estimate for the valuation of shares and revenue. A range of 280,000 to 350,000 can be considered. Midpoint is suitable, that is 315,000, but it needs to be discounted because this is not representing a listed company and is representing a non-controlling stake. So that's one part of this questions transaction, that how you are actually going to be recognizing it. No, you cannot recognize the value of services because you are applying IFRS 15. So with respect to IFRS 15, what you need to do is that you need to recognize at the fair value of. You have to recognize at the fair value of the consideration which is received or receivable. You have to recognize at the fair value of the consideration which is received or receivable. So the consideration that is received or the consideration that is receivable is basically the shares. So you have to recognize it as shares. Okay, Amna Mohsin, you did not understand the concept of discounting it. Discounting it means what? That this value is for the controlling stake of a company and of a listed company. If I am acquiring the non-controlling stake and that too of a non-listed company, so the value would not be the same. The value has to be less. Value cannot be the same. It has to be lower than that. Now, the second thing is, um, do we have any information about the investments? It's our own judgment. Okay, what happens is, furthermore, what is going to happen is the investment in shares is to be recognized at fair value through P&L or fair value through OCI. Since unlisted company shares, then highly likely to be recognized at fair value through OCI. Remeasure to fair value at each reporting date, gain/loss in OCI. If disposed, so that is something that you would have to do. So you could say that if I use this 6 million, 7 million So it's 6.5 million into 7%. I can calculate the value at year end. 455,000. The fair value has become 455,000 at year end. A gain of 455 minus 455 minus 315. So it's going to be 140,000. A gain of 140,000 is to be recognized in OCI. That is the accounting treatment that you will be doing. That is the accounting treatment that you will be doing. Okay. Because what happens is, generally speaking, when you have an investment in an unlisted company, usually what happens is you cannot trade the shares actively. And when you cannot trade the shares actively, that means they are probably not held for trading purposes. If they are not held for trading purposes, they would probably be held for what? For holding purposes. So if they are kept for holding purposes, therefore they have to be recorded as what? They have to be recorded as ideally at fair value through OCI. Yes, that's the only way. Now, what next is there? There's another aspect which is about the royalty of future revenue sales from Claw Music as revenue for the license. The sales of the Claw Music were 1 million. So what happens is, with respect to the royalty, you would say the royalty sales will be recognized over the period of agreement on the basis of royalty expected to be earned. The royalty sales over the period of agreement on the basis of royalty expected to be earned. Since in the present case, sales value of $1 million is available, therefore royalty of 5% into $1 million is equivalent to, how much is it? 0.05 million is to be recognized. So this is how you're going to account for it. I repeat, this is how you're going to account for it. Okay, shall I move forward to the next part of the question? Okay, now let's move. Omar, are you tired? Are you in Dubai or what? Well, those of you who wish to leave, you can leave. That is okay. No, Wajat, I don't take Salajit. Okay, let's move a bit forward and let's move on to the next part. Now it says investment in 4D company. It says DigiWire has agreed to work with tech game company. What has DigiWire entered? What has DigiWire agreed to do? Well, those of you who are unable to continue can leave and you can get the recordings later on. But the only thing with respect to the recordings is that you are not able to ask the question the way you are able to ask here. So now see what happens is um, it says DigiWire company has agreed to work with tech game company to develop a new music platform. On 31st December 2006, the companies created a new entity, the name of which is 4D Company, with equal shareholding and shares in profit. DigiWire has contributed its own intellectual property in the form of employee expertise, the cryptocurrency with a carrying amount of 3 million, the fair value of which is 4 million, and an office building with a carrying amount of 6 million, the fair value of which is 10 million. The cryptocurrency has been recorded at cost in DigiWire's financial statements. Now see what happens is it says that cryptocurrency has been recorded at cost in DigiWire's financials. Tech Game has contributed the technology and marketing expertise. The board of 4D will comprise directors appointed equally by DigiWire company and Tech Game company. Decisions are made by unanimous vote. Now, what exactly are we going to do with respect to it? It says based on IFRS, advise the directors on the following. The classification of DigiWire, of the investment with DigiWire has in 4D company. So you have to go for the classification. The derecognition of the assets exchange for the investment in 4D company and any resulting gain or loss on disposal of the financial asset statements of DigiWire, and whether cryptocurrencies should be classified as financial assets or an intangible asset. Your answer should also briefly consider whether fair value movements on cryptocurrency should be recorded in profit or loss or not. So what we need to do is that we need to talk about the accounting for this specific scenario. Now, how exactly are we going to be doing it? Let's try to discuss this. Let's try to understand this. It says, now, DigiWire has agreed to work with tech game company to develop a new music platform. On 31st December 2006, the company has created a new entity, 4D company, with equal shareholdings and shares in profit. So they've created a new company. They have contributed intellectual property in the form of this. Um, the tech game has contributed technology and marketing expertise to be this. So what are you gonna do? You're gonna say that the investment in 4D company needs to be evaluated. It's a joint arrangement under the definition of IFRS 11. Under this arrangement, a separate legal entity is formed, and the separate legal entity is being controlled jointly as only unanimous decisions slash vote can be undertaken. So as the unanimous decisions or the votes can be undertaken, that is something that you have to keep in mind. So therefore, this arrangement shall be, therefore this arrangement shall be classified as a joint venture and accounted for using equity method of accounting under IAS 28. So if you form a separate legal entity, that is going to be considered as what? I repeat, if you form a separate legal entity, that is going to be considered as so this is going to be considered as a separate legal entity, and it is going to be considered as a joint venture. I repeat, it's going to be considered as a joint venture. So what happens is that this is how you're going to be accounting for it. Now let's move a bit forward. What next is there? The next aspect is, yeah, if the unanimous consent is required, then it's an associate, because no one single person can take the decision. Now, the transfer of assets from DigiWire into 4D will be treated as disposal of assets and a gain or loss on disposal shall be recognized. Furthermore, an investment in 4D shall be recognized at the fair value of the assets transferred into the new company. So whatever the assets that have been transferred into the new company, what do you need to do? You need to establish the fair value of them. Now, DigiWare has agreed to work with this. So they've contributed an intellectual property in the form of employee expertise, cryptocurrency with a carrying amount of 3 million, and an office building with a carrying amount of 6 million and a fair value of 10 million. So what is actually going to happen is, so if we try to see this, the carrying amounts are what? The carrying amounts are 6 million for PPE and they are 3 million for the cryptocurrency. Their fair value is $10 million. The fair value is $4 million. 4 million plus 1 million. So resultingly, the total gain has to be $5 million. Just give me a minute. Okay, I could not find something anyways. So what have we done? We have contributed this. And as a result of this, how much, what have we got? We have contributed this property of 3 million. We have contributed this office building with a carrying amount of 6 million. The fair values of them have been what? The fair values of them have been 10 million and 4 million. So resultingly total gain in fair value is 5 million. Now see, it says the cryptocurrency has been recorded because the board of the tech game has contributed the technology and marketing expertise. So what happens is try to understand something. Um, I would need to get back to people on this, that how much is the gain that should be recognized. To me, it has to be 5 million. That is the gain that needs to be recognized. I repeat, to me, it's a 5 million. That is the gain that needs to be recognized. But anyways, this is what, that is something that is required to be recognized. Why not? What have you contributed? What have you contributed to the venture? You have contributed this much. Why should it be 2.5 million? Can you explain to me? You have contributed these assets to the group and to this joint. You see what happens is, so what happens? I don't get it. Why 50? I mean, it's not the gain. This gain is not for the, this, I repeat, this gain is not of 4D. This is the gain of us, the DigiWire. This is the gain of DigiWire. This is not the new entity's gain. This is my gain. Now, let's move a bit forward on this. So what happens is, to me, it has to be 5 million that needs to be recognized. Now, what next is there? The next part of this question was that you have to determine whether a cryptocurrency would be classified as a financial asset or intangible asset. Your answer should also briefly consider whether fair value movements on cryptocurrencies should be recorded in profit or loss or what. Now, see, try to understand this. What is a financial asset? What is an intangible asset? Financial asset is cash, right to receive cash, or there are further thing which is right to exchange financial asset for other financial asset under favorable conditions. What is an intangible asset? An intangible asset is identifiable non-monetary asset without physical. Yes, Wajad Arun, I'm trying to explain to you technically. Is cryptocurrency a cash? The answer is no. It's no cash. It's no. The answer is no. Now the concept is, does holding crypto creates a right to receive cash? The answer is no. That means, crypto is non-monetary. That's the one thing. Based on above, crypto is non-monetary. Now try to understand something. What is it? Does it have a physical substance? The answer is no. It's an intangible. It does not exist physically. The concept is it is identifiable. The answer is going to be yes, it is capable of being separately sold from the entity. Now, the important aspect is since crypto is neither cash nor n nor creates a right to receive cash, therefore it is a non-monetary item. It does not exist physically and can be transferred to another. Therefore, it meets the criteria of identifiability and hence will be classified as intangible. Okay, it does not create, I mean, you see, okay, Amna, just let me know one thing. You have an inventory with you. Does it create a right to receive cash? Okay, Tatenda, no. The inventory does not create a right to receive cash till the time the inventory is not sold. The same goes for crypto also. If you don't sell crypto, you don't get the right to receive cash. Till the time you don't sell it. Now, holding it does not mean right to receive cash. You see, if you are living in Europe and if you have got dollars, the dollars would be cash. It's a different currency, but a dollar means cash. It's a cash. Although it's not your local currency, but it's cash. I've not written the entire answer. It's just, I mean, like I've tried to create the scenario. The scenario from here till here is not an answer. This is not the answer. It's just that I've tried to discuss with you people. It is not an answer. I've just tried to discuss with you people. Okay, there's a question that I'm being asked. Why holding the shares create a financial asset? Because as per the definition under IFRS 9 with respect IAS 32 with respect to financial asset, it includes equity instruments of another entity. The definition says financial asset includes the equity instrument of another entity. So if you hold shares of another company, that means you have got a financial asset with you. Okay, now see. So this is done now. Now what next is there? What is the next treatment? It says explain the reasons behind the issue of the amendment to IAS, plan amendment, curtailment of settlement, and discuss the changes of the calculations. Um, of net interest and current service costs were considered necessary. Advise the directors on the impact of amendment to IAS 19 on calculation of net interest and current service costs. Now let's just try to see this through, that what exactly is it. Okay, have I missed out the measurement of crypto? Okay, it's an intangible asset um, with an indefinite life, so it won't be depreciated. Um, you can carry it under the fair value model because it's usually traded. So yeah, Anubhati, this is what is mentioned in the article. So that's what you have to follow, that you have to measure it using the fair value model. Now, no changes. I mean, the standards don't require, because an intangible cannot be recorded at fair value model. It has to be revaluation model. Now, it says explain the reasons behind the issue of amendment to IAS 19. Now, see, when we talk about pension plan, it says DigiWire company provides a pension plan for its employees. From 1st September 6, DigiWire decided to curtail the plan to limit the number of participants. The employees were paid compensation from the plan and some received termination benefits due to redundancy. Due to curtailment, the current monthly service cost changed from 9 million to 6 million. Relevant financial information relating to plan is as follows. Net defined benefit liability at 1st January 6, the opening. At 1st September 6, the date of curtailment. At 31st December 6, the discount rate is this. Yeah, this is part of the current issue, but let's have a discussion. What is it saying? Explain the reason behind issues of amendments to IAS 19, plan amendment, curtailment or settlement, and discuss why changes to net interest and service costs were considered necessary. Advise the directors of DigiWire on the impact of amendment to IAS 19 on the calculation of net interest and the service cost. Now see, try to understand this. What happens right now? If the curtailment occurs, the interest is computed on the opening balances. The second thing is the current service cost that is treated as before curtailment. What actually happens is that a large amount of movement goes to remeasurement gain or loss because of large amount of movement goes to remeasurement gain or loss because of non adjustment of interest and current service cost. So what happens is a large amount of movement goes to the other comprehensive income because of the reason that you don't remeasure the current service cost after the curtailment. I mean, you just consider the current service cost in the P&L the same that was established before curtailment. So now, under the old standard, the current service cost would be this 9 million into 12, which is 108 million. Under the new standard, the current service cost is going to be 6 into, no, sorry, it's going to be 9 into 8. Why? Because from this date to this date is 8 months. And this date to this date is 4 months. Plus 6 into 4. 72, 24. So this is going to be 96. And hence, there's going to be a 12 million adjustment to the current service cost under the new treatment. I repeat, under the new treatment, there's going to be an adjustment of 12 million to the current service cost. The current service cost would reduce by this amount. Similarly, if I talk about the interest, before it would have been like 3% into 30 million. Gives you 0.9 million. Now it's going to be what? 30 into 3% into 8 upon 12 plus 36 into 3.5% into 4 upon 12. This is 0.6. And this is 0.42. So resultingly, the net interest is going to be, the old net interest is going to be 0.9. The new is going to be 1.02. And hence 0.12 is what it is going to be. 0.12 is what it is going to be. So this is what the difference in interest is going to be. So hence, resultingly what happens is, the current service cost would reduce by 12. The net interest would increase by 0.12 million. So therefore, net remeasurement will be affected by what? The difference of these two. 11.88 million. I'll repeat it again. What would you do? You would say that before the current service costs were the 9 million estimated at the start of the year multiplied by 12. Now, after, what happens is the 9 million is for a period of 8 months plus 4 months plus 6 million for a period of 4 months. That's what you do. And similarly, with respect to the interest, right now it's like this: 30 into 3%. But now what is going to be 30 into 3% into 8 upon 12 plus 36 into 3.5% into 4 upon 12. This is what it is going to be. The revised treatment is going to be like this. So this is why the amendment was required. Why? Because when the amendment was not done, ultimately there was a significant difference in the amount of service cost, amount of interest that was all recognized. So we are done with this question also, which was about the DigiWire company. Okay. What next is there? So the time. Yes, both will be adjusted in P&L instead of the OCI. Okay, now see, the time right now is almost 2 a.m. here in Pakistan. So I think we should have to keep it till here. Well, Amna Mohsen, you do have an idea that how to handle the questions. So anyways, what I'll do is that I will end it here. The initial part of the class was conducted on my Facebook page, and the remaining part of the class after the break has been conducted on the YouTube. So I'll share the details with you people. I'll also share the answers to these questions to you people. No amendments in the March exam. So thank you very much, all of you, for your time. Thank you for attending the session. Thank you for staying connected. I'll be available in the WhatsApp group to answer your queries. So you are most welcome to ask the questions in the WhatsApp group, because that helps everyone else. And what happens is I actually, it's always good that the other students can answer each other's question. Um, Thank you very much. All of you, thank you for your feedbacks, thank you for your comments. uh, there are many people. I'm really sorry I cannot take out name because my chat window is moving so fast. uh, Hamad, thank you. Tatenda, Wahib, Ahmad, Baba Sese, Amna Asgar, Amina Mohsen, Shilpa, Anubati, Wajahat Harun, Mortlatsi, Baba Sese, I'll discuss with management. Kemi, thank you. Umar Khalid, thank you. Ademola, Amna, thank you. Thank you all. Uh, Yolanda, thank you. Osman, Sanazafar, Alia. So thank you very much, all of you. Thank you for your time. Thank you for everything. Let's meet up inshallah soon, and wish you all the very best for the exam. Yeah, the solution would be shared